One, two, three. Oh, I hear people. Can people hear me is the question. Anybody?
You are now muted.
Great. All right. And I assume you can see my screen. Yes. Any yeses? Well, now you're saying yes to anything. Screen yes. Okay, I'll take that as a yes. All right, let's get going. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. NewToPhilStockRoll.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors, or in such capacities, licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not discuss or distribute your information to anyone. Fantastic. That is fantastic stuff. All right. How is everybody doing today? Let's see. The market is doing so-so. Let's take a look. What is this? Why do we have natural gas there? Okay, well, that's because I'm trading it, that's why. I have 4 long contracts at 217 average, and we're only at 215, just under 216. So losing money. So that's one trade I'm in. Otherwise, I'm not in any of these at the moment, so we'll see what happens. I want to put that back to who's missing. The S&P is missing. Let's just keep an eye on our indexes for now. Right at that critical 1870 line that keeps getting rejected, so hopefully we can pop over that. Yellen is still talking. This is unusual. It's 1 o'clock and it's still going on. He's asking her a lot of tough questions today. And we'll see how it goes. Overall, we're just basically struggling to get back to the highs where people were optimistic ahead of the Fed. But the NASDAQ is coming up. Apple, that means, is probably doing good, 95 and a half. The Russell, so the NASDAQ is the closest to breaking up over the highs. Nikkei still under 16,000. The dollar is not doing anything exciting here, so that's not really a factor. Gold is sort of fluctuating around in the 1190. Silver's 15 and a quarter. Here's Boeing. We like Boeing long here. We picked that last week. Oil, gasoline is really taken off today. Had a nice run off. 90 cents yesterday. It's already up at 95. That's a nice couple of $1,000 run. Here's wind. I don't even know why they're on. I just have to restart my computer. It's going real slow. All right. So like I said, I think I have my audio back. Can you guys hear me? Yes, good. Okay. And now I'm going to try the screen share again. That's where we crashed. Sorry about this. I guess I'm trying to get a new computer because this is a little unreliable. Basically, I blame Windows 10 though, because ever since we put Windows 10 on, it's been a disaster. And that should be the screen sharing back on. How are we doing? Okay, good. All right, what were we talking about? We weren't talking about anything in particular. All right. You're on that multi-screen. Maybe it can't handle a multi-screen. I don't know. I wonder. Oh, dear. All right. Well, while we were talking, the indexes took a little turn down. Very hard to see the minute-to-minute problems on the market, but it's, what is it, 1 o'clock? Let's take a look at the news on Seeking Alpha, see if anything's happening. Man, everything's slow. Something's wrong with memory in my computer, I think. So while we're talking about that, we can take a look at what we've been chatting about today. We started the day off. We were talking about bounce lines in the futures. We didn't break over our better levels, so now we're going to have to see if we retest these lows at some point. We didn't do such a great job on the upside today. It only came up to where we thought it would come up. So basically what we're doing is failing at a weak bounce line. That's all, which is not terrible, but it's not good. I mean, we really need to start making some ground up. But again, we're not, there's a false premise. People think that, where's this chart? People think that we're coming back to here. Where's the S&P? Here's 2100. People think we're coming back to here. We're not coming back to there, okay? Everybody now knows this is not the right price. This is the right price, maybe 1950. So when we make a tiny bit of progress back towards 1950, that's good because that's all we're going to get to. There is no up here. That's gone. This fantasy is over. This fantasy on the NASDAQ, it's over. All this is fantasy money. This is 20% of fantasy. Okay, you'll be lucky if you get to 4,400, which is 10% up from here. Basically, a little bit up from here, 4,300, whatever. That's where you should be because, frankly, you shouldn't pay 100 times earnings for tech stocks. Amazon.com should not be 1,000 times earnings, and that causes 100 NASDAQ points when you're paying that much. It's not going to come back because people are getting less stupid. Tesla too. It's not coming back. In fact, it'll probably go lower because it's going to get priced like a real car company with real car company problems. All right, the economy isn't that strong. Earnings aren't that fantastic. And there's not any great projection of growth ahead. So under what circumstances should we be way up here, where everything was awesome at one time, right? This is a correct price for the market where we are now. That's why our must-hold lines are here. They're not up there. They're down here, where we are now. Okay, we're barely, the Russell has failed. The NYSE has failed. They failed pretty badly. The Dow is basically, is the Dow even, no, the Dow is below here too. We're barely holding the bottom end of the range. Okay, so here, this is our range. Here's the low end of the range, and we're in a bad time where people are worried about stuff. We're in the low end of the range. That's perfectly normal. But it's normal for this. It's normal to get back to 4,000. It's normal to get back to 1850. It is not going to be normal to expect us to be at the top of the range. And even the top of the range here is a lot lower than where we were before. But that's the range we're in there. You guys, it's very important you accept that and adjust your trading accordingly. Because if you've got a bunch of trades where you're paying premium, where you think things are getting back to their highs, that's going to be a big mistake. You're going to watch that premium erode over time. Now, on the other hand, if you're being the house and you're selling that premium, it's brilliant. And also, this guy, the more he wins, oh, I didn't want to do that. the more he wins, the more nervous corporate America is going to get. He wants to take their money. He wants to take rich people's money. And by rich, by the way, he's talking about people who have like more than $10 million in the bank and people who make $1 million plus a year. Not regular people, not rich like, oh, I have $1 million house rich. Rich like, oh, I could buy $1 million house and then not even flinch about it kind of rich. You know, you know, it's. I like his policies. I think he's right. We obviously, you can't let one part of society make that much money. It's just not. It doesn't matter. Even if they're the only ones that are good. It's like if you had a baseball team and you gave all the money to, let's say you had a pitcher who was 25-0. Right, on a baseball team. How many guys are on a baseball team? 27 guys, right? So you have one pitcher. Say they have $100 million for salaries. Well, no, I wouldn't even cut it anymore. You have $200 million for salaries. And you have one pitcher who goes 25-0. He wins every game he starts. Every single time he wins, no question, shuts out the other team. No one's ever gotten a hit off this guy. So it's 25 no-hitters a year. All right? What do you pay him? Well, the best pitcher in baseball makes $20 million a year, let's say, so he's got to be worth much more than that. So what do you pay him? $40, $50 million, $60 million? What does it do, though? Then you're only left with $150 million to pay 27 other guys. That's what we're doing in society, okay? I don't care how good Bill Gates is at whatever the hell he does now. or any of the CEOs or whatever. But when you pay them some huge disproportionate amount of money, when you let a hedge fund guy make $2 billion and you don't tax him back because he deserved it. You know, he was smart. He worked hard and got that money. Okay, that money is coming away from other people. Because see, you know, when a hedge fund guy, when I make money in the market, I'm making it from someone else. I'm not creating money. I didn't do anything. Money is coming from someone else to me. They lost, I won. That's how it works. Now, in these companies, it's the same thing. They're not necessarily, especially financial companies, they don't create anything. A financial company is the same as any gambler in the market. They're just gambling. They don't create anything. They actually take money from the people who produce stuff. You know, you're a builder, you build a building, the bank finances it, they get their 10%, you're out 10% of what you made. Because the bank financed it. Why? They have a monopoly on financing. That's how it works. And all Bernie Sanders is saying is when people make excessive amounts of money, and excessive is defined at a very, very high level, but when you make excessive amounts of money, when you make $10 million in a single year, when you make when you have $100 million bank account, he's like, well, that's enough. After that, you don't really need any more money. So yeah, let's not incentivize you to make more. There's really no point. There's nothing wrong with that, okay? Especially because the problem is the more money you make, the more money you're taking from everybody else. And on the whole, that's bad for society. It's only good for the people you hang out with, and that's only if you're not a tightwad. If you're a tightwad, it's not good for anybody. All right, so anyway, moving on from that. So anyway, so the better Bernie does, though, the more nervous rich people and the top corporations and things like that are going to get, because it's going to impact down the road. It's going to impact budgets. It's going to impact taxing. It's bad for the military. So we're going to be watching that stuff really closely as it goes on. I don't think Bernie will ultimately win. I think he might be vice president, but that's besides the point. Solar City, we went over like what a joke that thing always was. I've never liked Solar City. These are some comments I made going back a couple of years. We used to short them when they were 75. Now they're 20. But it's just it's not coming back because this is what the business is. It's a low margin business. And now people are realizing it's a low margin business. They're never going to make a lot of money. It's not going to happen. Disney, on the other hand, is really underpriced. They got beaten to crap for no good reason. Now, oddly enough, it's funny, we had it in the butterfly portfolio, I think we still do, but we were long on Disney. Then they hit 120, we went short, and we actually started going short. We had a short call, and we let it ride, and we were worried about it here when it touched 120, but we held strong. and they fell back off, and we collected all our money. But that left us in a long position on Disney, which is getting beaten up right now. But we are going to absolutely press this bet. The value of Disney has not changed. It's still worth $100, $105. I never thought it was worth $120. That's why we went short at $120. So when it's at $120, I didn't think it was worth $120, and when it's at $90, I don't think it's worth $90. I think it's worth more. The value remains the same. It's just the price that's fluctuating. But over the long haul, who the hell cares? In fact, here we go. See if I can get a chart. You know, this is all perspective stuff, because people don't think about these things. Well, that's weird. What's the time frame here? Oh, they don't have a long time frame. Well, they do actually. Wow. They did nothing, and then they really took off, didn't they? Look at that. So, you know, all this is a normal pullback. That's a hell of a run. See, they have this big run, then they have a sharp pullback. Looks just like this one, right? Then, up they go again. You know, I think it's too soon for them to go up that far, but look at this run, man. Holy cow. I didn't even realize they went that much. Wait, 5 years. Here we go. So in the grand scheme of things, up from 25 to 125, now they're pulling back to 90. They can pull back to 75 for all I care, but I think this is around, you know, the low, basically in a range of 100 to, if 100 is the right price, then 75 would be a good channel low. That's more than 20% below. 125 is good. Probably 80 would be the low. And then back to 120. And eventually they'll consolidate here a little bit, and then they'll move back up. Then they're going to be ready to go. But they have to grow into that valuation. They're making $6 a share. So $6 a share for a company that's growing at about 10% on a regular year, 5-10% earnings at least every year. You got to give them a multiple of 15 at least. So 15 times $6 is 90. I don't, you know, and people are going, oh, ESPN, this and that. They're picking one thing, which Disney, by the way, is very dependent on ESPN, though. They get a lot of revenues from ESPN. It's, let me see. DIS. Here you go. Company profile, Thinkorswim. Here you go, ESPN channels, 27%. That's a lot. But, you know, all their other metrics are doing great. Disney Studios, gangbusters. Broadcast is doing well. Disney Channel doing well. Parks and Resorts, fantastic numbers. Consumer products, fantastic numbers. This one thing is doing poorly. But even if ESPN dropped, and it dropped like 5%. If ESPN dropped 20%, you have to keep in mind that 20% of 27% of their revenues. That's 5%. It only dropped 5%, which is 5% of 27% of their revenues, which is 1%. So they take a 1% hit on ESPN, but everything else is doing great, and the company is treated like it's going broke. That's idiot. People don't know how to value a company or assess a situation. And also, we heard from Comcast, and Comcast said they're really not seeing as much cord cutting as you think. It's just not, because I can see why. It's a convenience thing. My kids have Hulu and Amazon. They have Amazon. Well, Amazon Prime we get for free because we subscribe. You know, because we have the free delivery things from Amazon. So that we have automatically. We have Hulu. We have Netflix, and we have TiVo, which is, you know, what I consider TV, though I don't consider that cable. And we have Comcast, and they have an on-demand service. And honestly, I don't have time. I can't even be bothered. Who the hell looks from one thing to the next to the next? I'm not going to, you know, the thing I use is my TiVo, because that organizes Comcast and everything into one bundle. But I don't go to Netflix and I don't go to Hulu because it's a hassle. And so people who unbundle stuff aren't going to start buying discrete things one by one and going here and there, unless there's some kind of an app, which may become Apple TV, but unless there's some kind of a thing that sort of combines them all and makes them convenient. There's no, you know, people don't want that. People don't want to have to go 10 different places to find things. and to organize their shows and stuff. It's just not going to be very popular. It's going to be popular with people who want to save money for kids and things, college students who care about, $5 a month or $10 a month. But for wage earners, people who have cable TV and pay $100 a month, they're not going to try to pay $95 a month or $85 a month. It's not going to make enough difference to not have the convenience of just being able to turn the damn TV on and watch what you want. That's what I think about it. What else? So that's not it. That's it. And what was this discussion then? Then we talked about oil. We talked about gasoline. We talked about, here's CVS. We like that one. We added CVS to the long-term portfolio by selling the 2018 puts for the 2018 $80 puts for $760, and unfortunately keep going up today. So you probably can't do $760 anymore. But selling the $80 puts down here, 80, sell them for $760, maybe $7 now, and you're netting in for $73. And it's at 93. So you get a 20% cushion, and they're going to pay you $760. So we sold 5, so let's say we collect $3,500 in the long-term portfolio for selling 5, and our worst-case scenario is owning CVS for $80. So I like that trade. And we like to do that once a month. Once a month we try to find a $3,000 or $4,000 trade because, obviously over the course of the year, if we do $4,000 a month, once a month, that's $50,000 that we're dropping into the long-term portfolio. And all we're doing is once a month we promise to buy some stuff. And I'll show you how that looks in a minute. We'll go look at the portfolio. We talked about rate hikes. We talked about oil inventories. Oil inventories had a little bit of a draw, which surprised people. The gasoline and distillates, though, built up. And by the way, this is what I said would happen. I said that they would be refining a lot of gasoline and distillates because they got to get rid of it. They got to make space for all these barrels that keep coming in because our inventories are getting full. I talked about that the other day. What's this? I'm going to be on Money Talk later. Here's what we discussed what I'm going to be talking about on the show. So here's a little preview. We're going to be talking about the levels of the market, the overall macro situation. Then we're going to talk about oil, the market cycle. We're going to talk about oil supply and demand, something I wrote an article about the other day. And we're going to talk about our trade of the year, which is UNG, and why we like that. And we're going to talk about Ford, how I like Ford. And our trade idea here is to go forward is to buy the 2018 $9.75. They had a special dividend payout, so they end up being $9.75 call strike. So it's a $9.75 $10 call spread, and we're buying that for net $1.10. Then we're selling 50 of the 75 puts for $1.50. So I take 75 off each of the 110s. So that's what, like 45 cents, right? So the net on the spread is 45 cents, or I guess 35 cents. Sorry, 35 cents. Net on the spread is 35 cents. So you're paying $3,500 in this setup, and then you have a $50,000. No, sorry, not $50,000. You have. Where's the math on this? Is that right? Oh, I'm sorry. You get $22,500 back if it goes well for a $19,000 profit. Now, the cool thing about this trade, though, is Ford doesn't. This is what I mean about playing for a flat economy. We're not playing for Ford to go up. It's at 11 something now. It's at 11.40 now. So we're only saying it's going to go up to 12 in 2 years. We're not looking for any kind of giant recovery in the market or anything like that. We're just saying we think this is a fair price for Ford, and all it has to do is stay at a fair price, and we're going to make $22,000. We're going to make 542% return on our cash. That's not bad in a flat market. That's the way to trade it. And if you have an IRA account and stuff like that, and you want to make a trade, you can do it like this. And this way is where you buy the shares, sell the call, sell the puts. A little more conservative. And that one, that still makes 50%. It makes 25% doing it that way because of the dividend. Ford has a nice 5% dividend. Then Scott mentioned he thought UNG had a lot of decay, and I said, no, it doesn't. Because here's 2012. You got to line up because 2012 is here and 2012 is here. But if you look at UNG and you look at the natural gas actual prices, they line up really well. You are not getting a big decay in this is the ETF. The ETF does not have a tremendous decay. It actually goes quite well along with it. The ranges are different, of course, because here's 30, and here's 7, and here's 6, and here's 2. But 7 is about 1/3 of 30. Well, actually here's 28, so realistically. So here's 750, so say it'd be 750, 15, 2250. So really 2250, and you could say 25 arguably. So maybe over the course of this amount of time, maybe a 10% decay over a few years. That's really not a bad rate of decay. All right, and that takes us to where we are here. And now let me see if I have any questions. Not there. There. I'm sure we do. So starting here. Oh, wait, okay, so reset when I came back in. Okay. What do you think about the UCO, WTI current levels? I do like oil here for a long-term play. You have to be at least into the summer for targets. But if you're moving for July target, I do think that 27.50 is a good bottom for oil. It's at 27.63 right at this moment. So it's still dangerous to play long. There could be a panic and fear and spike it down lower. So you don't want to get into something you don't want to adjust, but you want to. But as far as a long-term play, yeah, I definitely like putting a stand down here. In the short-term portfolio or the 5% portfolio, we already, I think, we already have a UCO play. Let me see. Oh, it's not so bad. We're only down 9%. So there's the options opportunity portfolio. It's down 9% at the moment. Oh, and here's our spread. What we did is we took the UCO 5-10 bull call spread, which is probably, yeah, you see right now it's a lot, so that means you can do this for better than we did it. The UCO 5-10 spread, notice it's at 650, so it's in the money. And we paid, whatever this is, $2.15 for this spread. That's July. Then we sold, instead of selling UCO, because now UCO does have a bad decay rate, so we don't want to sell long-term UCO puts. Also, it's obviously very volatile being an ultra. We want to be volatile on the way up. We want it to go flying up into our range, but we don't want it to go against this volatile. So what we did is instead we sell the 850 USO puts. Now, at the moment, USO is at 8 with oil at 27.50. So roughly, we're betting on $30 oil in July. And we collect ourselves $1.10. Now, what do we spend on the spread? We spent $1. No, we spent $2.10. So we're netting $1 on the spread. So we're risking $1,000 overall. Okay, our net outlay here is about $1,000. And so what we're risking being assigned 1,000 shares of USO at 850. And on the upside, if all goes well, though, we're going to collect $4,000, net 4, because we've spent 1,000, and we'll get 5,000 back if UCO is at 10 in July. So that's what we're going to be looking for, okay? And we're talking about maybe oil should be about 30. We're looking for like $35 oil in July. That's going to make this trade work. So that's how we want to play it. Wow, how are we doing so? Wow. Oh, wow, this came back nicely. Okay. Oh, I'm sorry. I didn't enter this. We did a roll on this already, so we'll see how that works out. But the original one came back nicely. It was way down, and now it's calmed down a bit. But we actually rolled it to June 27th, I think. It's not reflected here yet. So where were we? Is the next 5% move in the equity market likely to be up or down? I think up. I think we're at the bottom of our range. I mean, that's what the big chart's telling us, and it's not wrong very often. So we should be at the bottom of our range. And by the way, the big chart is based on me revaluing the thing on a regular basis. In fact, that's, I don't say that's why it's never wrong, but where are we? Oh yeah. You see, I made these two notes, so if you go back in the chat, you'll see it. On 8/13, we valued the S&P 500, and that's where we didn't change it. We've had the same valuation since the fall of 2013. There's been no change in our valuation of the S&P since the fall of 2013. At the time, we were bullish because we were well below those targets. But now that we're in the range, we still think that's the correct price. It hasn't changed. But in August of last year, we went over the S&P 500 and we said, you know what? We still think this is the same price. This is what we still think 1850 is the right price. And then in January, just a month ago, we valued the Dow. And again, I came up with the right price and I said, here's the bottom. But the good news is we can call the bottom here at 16,000. That's what I said on January 14th. And since then, so on January 14th, let's see, this is the 11th, 12th, 13th, 14th. So here, January 14th, I said I think 16,000 is a good bottom. Now, it went lower. Just because I think something is a good bottom doesn't mean it's not going to go lower, but as far as from a playing standpoint, we liked it for long. And actually, every single day after that, it was at least at that line. It never stayed below it for the whole day. So 16,000 was a good long. We had this little ride up, but then we failed at what we expected would be a weak bounce. This was a failure of a weak bounce. Then we came back, testing 16,000 again, and now we're probably going to make another run back to a weak bounce. But there's nothing impressive about that. And once we fail this weak bounce a couple of times, it's not going to be a weak bounce anymore. That's going to be your new range. You're going to be in a tight little range that's probably going to go from 16,000 to maybe 17,000. Maybe. But that's like a 10% move up almost. You're going to have a hard time getting that far. You're probably going to be in a 5% range, which would be 800 from here, 16.8. You see that 50-day moving average? It's right at 16.8. So logically, that's actually reinforcing the 5% rule. 16,000 plus 5% is going to be 16,800, and that's where you're going to get stuck, right there. Right at that 5% line is going to hang out. And eventually this line will come down, and we may not break out. If you want to do a calculation now, this is the 200-day moving average. It's very possible that we will not break out until this line comes down to 16,000, or at least 16.8. So it's at 17,250 now. It was at 17.5 a little more than a month ago. So that means we need to get down another 400. So let's say it's going to take 3 months. All right, so this is all of February, all of March, all of April. So sometime around the next earnings season, in May, is when we can expect to see a break higher in the Dow, assuming, obviously, that earnings go well. But at that point, the averages, we're probably going to squeeze in this zone. We're probably going to squeeze around here all the way until May. It's going to become very dull. All this excitement is going to fade out. The market's going to get really dull. Everyone's going to get nice and complacent. And right when people tell you to sell in May and go away, if we have good earnings, we'll pop up and have a good summer. So there's your 4-month forecast in a nutshell. All right, back to questions. 2 questions. How dare you, Joe? NGK6. What is that? Oh, now that's natural gas. Those are the main natural gas contracts. Low price to enter. Yes, well, I'm in them. What am I in them for? Confuse me when I have to look. Charts. Not those charts. Don't crash. So you're going to make us crash and everyone's going to be mad at you. I'm in for 217. I have 4 of them. I'm down $380 at the moment. I should get back to 2 if I get even. In fact, I should get back to 2 anyway. But I don't know. I mean, frankly, last time we had a big crash in NGs, I went to 20. Remember, and I made like $50,000. So I'm not really adverse to adding as we go down lower. I don't know how low we can go, but the regular NGs went down to 180. So let's see how much pain I could be in. We're at $2 now. The regular NGs went as low as 180. So if we assume that the K6s will drop at least, let's say they drop 15 cents and they come down to $2. Yeah, $2 should certainly hold. 15, that would be 15 cents would be what? 1,500 per contract, right? So at 15 cents, I would be losing 6,000. No, see, that's nothing. I wouldn't. That's nothing. I mean, to me, I'm sorry. I know it's offensive sometimes when I say that, but I could lose $6,000, which I could care less, and then I would double down and be very happy to have 8 at an average of, let's say, 210 or less. So if I double down to 8 and have 210, and I might even double down again and go 16 and be at 205, I would be happy as a clam at 205. So the answer here is I would not be selling here. I really have no desire to sell, and that's not necessarily the best practice. I play, again, I have a lot of margin, and a lot of money to deal with, so I don't worry about these things. To play carefully, you really should use stops. You should stop out. If it doesn't hold 215, I should stop, wait for it to settle down, then get back in. But in my mind, I'm already going to double down, triple down, and whatever, and end up with 4 times what I have now. So it's not important for me to save to try to save the couple of $1,000 on the way down. But the proper way to play is to set a floor like at 215 and say if we can't hold 215, then we need to get out and reevaluate. And again, if I had 20 here, I would be stopping at 215. But at the moment, I intend to get 20, so this is not important to me. But still, from a discipline standpoint, if we get back to 217, I should stop 2 out and be back to even. All right, and then that way, when it goes down again, I'm going to be much happier doubling down. Here's my Nikkei too. I have 6 Nikkeis, and those are down $1,500 at the moment. So we'll see what happens here. Now, on the Nikkei, I'm really not in for the long haul, but I just want to see if we can get back over about 16.5. I think we're going to have I think now that Yellen's done, I think we're going to be able to put together a stronger finish. And then overnight, the Nikkei is probably going to have a good move up. We'll see where the dollar is. Charts. The dollar is here. The Nikkei would like it much more if we had a stronger dollar, but I don't think that's quite going to happen right now. So it's iffy overnight. But again, I do think we have a nice little market bottom forming here, so we'll see what happens. And I think I mentioned this morning that of all the bets, the Nikkei has a chance to do something very impressive. Like, what did I say this morning? I forgot. I know I was smarter this morning than I am now, so hang on. Here it is. Oh, yeah. The Nikkei can easily put up 1,000 points. That's 5,000 per contract. So I'm looking for like 25,000 bucks if this goes well. This is unlikely, but if something does happen, they can pop back to that line without much resistance and be 18,000. That'd be $10,000 per contract. So again, that puts my possibly losing 6,000 bucks into perspective. I'm really not, extremely worried about that. I'm playing to win $50,000 on the Nikkei. So I'd rather be in it than not in it, and if I have to lose a little bit of money to maintain, I don't mind that. Simple play on USO selling a put. Well, a simple play on USO selling a put is just sell a put. That's not hard. Come on, man. What are we doing here if you need that? Here's USO. USO, though, does decay. It's not the best thing to really sell a put for, but let's ignore that. It's at $8. So all you can do is go to July, and you say, well, certainly we're going to be higher than we are now in July, so you can sell the $8 puts for $1. You can sell the $9 puts for $1.78, and that's 20%. And all it has to do is go to 9. 9 is a little more, but let's say 10% higher than where we are now. We're at $27.50, so you're really looking for $30 oil in July. So if you sell this put for $170 or $180, you're netting in for $720. You're netting in for $720. So in other words, oil would have to be $25 in July for you to lose money. But if oil is $30 in July, you'll make 20% in 6 months. So I think that's pretty simple. It's a great use of money. It's also margin efficient because I very much doubt they're going to have a high margin on this trade. Let's see what Thinkorswim says. If we sell 10 of them for, what's going for, 178? We sell 10 of them for 178. It's going to be, look at that, $400 in margin. $400 in margin to make $1,700. That is fantastic. That's a 10, of course, because I already set mine to 10s. So that's a nice margin efficient trade. Makes it makes 20% on the position, but realistically, what are you making? You're making on $400, you're getting $1,700 back. You're making like 400% back on your cash. Well, not in cash, on your margin. You're making 400% against your margin. So that's a fantastic trade. I highly recommend that one. There you go. Super simple. And by the way, you see that? So when you have a premise and you have a pretty good idea of what's going to happen in the market, you can make a huge amount of money. Because what he's saying is, how can I make money on USO when we have this assumption that we know that oil is bottoming here? How do I make that money? So you think, look, let's look at USO. Okay, I know what's going to happen. And I know it's arrogant sounding, but I know oil is not going to be $25 in July. Okay, oil might be $25. Oil could be $15 in March or maybe even April, but it can't last. And it's going to be a big washout of that price, and you'll see people go bankrupt and whatever. But as soon as a big Venezuelan company goes bankrupt or a Brazil company goes bankrupt that produces 2 million barrels a day, and it takes it off the market because they shut down operations, boom, crisis solved. I mean, the crisis of the oil companies is solved because all of a sudden instead of everybody voluntarily cutting back, one guy goes bankrupt and stops pumping. That's all it takes. And that's not even counting like a war or a rebellion, some agreement with OPEC. There's all kinds of reasons it can go up between now and July. What I can tell you is not going to happen is they're not going to keep losing billions and billions of dollars a day producing oil. Something's got to give in the next 6 months. Where are we? Okay. Wait, what happened here? I feel like we get 2 questions, right? Oil and market seem to be moving together. What's the drive? Well, everybody thinks that oil. This is, again, I talked about this the other day in the Morning Post. Everybody thinks that low oil prices mean a bad economy because in a internal combustion engine economy, which we've had for 100 years, basically. So every single person who's on the planet today has grown up and been taught by people who absolutely believe that the internal combustion engine is the best. The use of oil for internal combustion engines is the single best indicator of economic health, and that has been an absolute fact for 100 years. It is no longer a fact. We have driven efficiency, and again, this is what I'm talking about on BNN today. If I can find it again. See, I'm going to really educate these people on BNN. Look, 1980. Percent change since 1975. In 1980, we used 20% less oil, or we became 20% more efficient, let's say, than we were in 1975 on a per horsepower basis. So we're getting more horsepower for the same weight, right? Not much more. For 20% more weight, we're getting much more horsepower. We're getting much, much better fuel economy. There's a huge change between 75 and 80. What was that driven by? That was driven by the Arab oil embargo that shot gas prices up, and it changed our concept of cars where no longer did we want muscle cars that got 6 miles a gallon, 8 miles a gallon. I remember I had a Cordoba. I had a beautiful Chrysler Cordoba with Corinthian leather. It was a great car. It got freaking 8 miles a gallon. 8 miles a gallon. I mean, literally, these were in the days when you had to have all your friends give you $1 for gas because you were going somewhere. Everybody had to put in $1 because it was going to literally cost me $5 to drive 40 miles. So it was a fantastic, beautiful luxury car. I totally loved it. The freaking thing, you had to really drive from gas station to gas station to get places. But so many cars were like that at the time. I mean, that was just normal for cars. So we had a pretty big shock as prices shot up in gas. Because I remember when I was a kid, which was here in 75, gas was 35 cents, and like 5 guys would come out and wash your windows and check your oil and blah, 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 and you get like a Mr. President's coin game or one of those little dinosaur cups. You know, you always get a prize, and you get your windows washed and all that, and that was 35 cents a gallon. Then all of a sudden, when I get my license in 1979, 78 actually, I got my license in 78, right at that time, that's when it happened. That's when all of a sudden oil prices started shooting up. The gas went from like 60 cents a gallon when I started, and by the time I had my own car and I was driving around, it was like $1, then it was like over $1. It was ridiculous. You know, it certainly seemed that way at the time. And what happened though? Look how easy it was for us to change our minds about what was important. We lowered the horsepower of our cars. Oil prices went up, and we reduced the horsepower of our cars, and we increased the efficiency drastically. So we started using a lot less oil. This trend then became embedded, though. It became ingrained in what we do, getting better horsepower out of the same fuel economy. And what happened here is as oil prices shot up again, there's been a resurgence in the research and development and the demand for this kind of fuel efficiency that's really now going to propel us for another decade or decades of rising efficiency. So what was true for the first 75 years of the world, that oil was $10 to $15 a gallon, and people burned it like crazy because who the hell cared? It wasn't worth worrying about. Suddenly, people started worrying about it, and we became efficient. So, at this point here, when you're 60% more efficient in 25 years, all of a sudden, the paradigm, the thing that was true for the first 80, 85 years is no longer true. But the problem is, who's teaching anyone that? Nobody. Nobody talks about it. Nobody understands it. It's a new paradigm, and nobody understands how this is working now. And what I made a very big point of here, and I won't get too into it, but here's fuel efficiency on cars, and look at what's happening here. From 2000, here's 2008, whatever, when oil prices skyrocketed under Bush's brilliant plan. All of a sudden, everybody starts kicking up in efficiency. All right, everybody, because again, the same thing, demand drives it. But then we're on a track. Now everybody's setting targets now that in the next 5 or 10 years, we're going to again go from 35 to 50 miles a gallon. We're going to make another 30% increase in efficiency. That's going to drastically drive down the consumption. It doesn't matter that everybody drives the same amount of miles. They're going to use so much less gas, and we're not growing the amount of cars. The global economy isn't growing that fast. The population isn't growing that fast, that we're going to suddenly have 30% more cars to make up for it. So therefore, demand goes down. And that's just cars. You know, as everybody's using compact fluorescent lights or LCDs in their homes. Those use 1/10 the amount of energy. And it's not oil, it's other forms of energy. But on the whole, our energy consumption is dropping off drastically. And so even if we do end up giving light bulbs to everybody in Africa, and if we give a car to everybody in China, it's not going to be enough to make up for the decline of all the people who already have cars and lights, and their decline in usage. So oil is in plentiful supply compared to demand, and it's going to remain that way for quite some time. Maybe forever, because we're getting more and more efficient. So demand is not necessarily going to grow every year from now on. Demand is probably going to be in a slight decline. And that's the thing also, you have to realize, you know, when a Chinese person gets a new car, they're not getting a 20-mile-a-gallon car, they're getting a 50-mile-a-gallon car. That's what they have in China. With China. China's blue. Okay, well, they're here. They're at like 35 here, 37. But in 5 years, this is a mandate. And so when China has a mandate, it's a mandate. 50-mile-a-gallon cars. How much gas are they really going to use over there? How much oil are they really going to consume? And then you have to account for the fact that within 10 or 15 years, they're going to make advances in battery technology that's going to flip more cars to electric. And they use zero oil. And then the electric, and as people have been arguing recently, then of course you don't get electricity from oil. So that's zero oil. There's no demand for oil when people start using electric cars and stuff, just leftover trucks and planes, and those eventually will move too. And that's another reason all these oil companies are pumping like crazy, because they've got 40, 50 years worth of oil in the ground. We're not going to use oil for that much longer. We're going to stop using oil before they run out of oil in the ground. So if they don't pump it out now, it's only going to get cheaper and cheaper and cheaper as time goes by, as less and less people want it. But in the short run, that doesn't mean that we're not going to go up between now and July. But that's the overall, it's just never going to come back the way people got used to it as. All right. Dollar getting kicked down. I mean, look, the dollar's going to move around based on whatever Yellen said today. And she basically, she said we're not rushing to raise rates. Nothing's going on here. We have no targets. We're not going to definitively raise rates. We're waiting to see what the data is. And obviously the data now currently sucks. So you look at the data now and you think, well, this is nothing. There's no reason to raise rates now. They're not going to raise rates in March. There's no chance. And I've been saying for quite some time, most experts are saying they're going to have 4 raises this year. There's no way they're having 4 raises this year. 4 raises means they're definitely going to have one in March. There's no way they're having one in March. That's out the window. So they're going to have the March meeting, no. April meeting, probably no. Then they don't, I think they skip June and go to July or something like that. It's just not going to happen. If you're lucky, if in the summer we look good enough that they're going to raise rates once, and they'll do that, and then maybe once again in the later part of the year. But 2, I think 2 and 3 would be a stretch this year. And so most people think they're going to raise it 4 times, so they're wrong, and that means that the Fed is more dovish than is being realized by the market. Shorting Amazon, I would not short Amazon. Well, look, it's dangerous. I mean, believe me, I hate Amazon. It's still not worth it. They could lose 50 more % and they're still overpriced, but it's a very dangerous game. Especially when the market is so low and the whole thing can bounce back. It's a really crazy stock to play. I would wait for a nice run up to short them if they have a run up. But we just learned to stay away from Amazon. I think no other stock has burned us more times than Amazon, or more badly. Because it just, you think you got it, and then it gets away from you. Damn, I wish this thing wouldn't do that. It can never keeps bumping around. Where do you see the Dow going back as a high, Phil? Again, it's 16,000 plus 10% is 17.6. So I don't think we get much over 17.6. Oh, you mean you? I lost track of that comment. Can you explain how you apply tight stops to futures trade statement? No, manually watch, because they'll spike it, and that's part of the trick of learning to be a good futures trader, is you have to learn to identify the difference between a spike down that's probably going to reverse and an actual move. So, it's something, it's hard to explain. I mean, obviously it goes by looking at something. Oh, see, here we go. All right, so on natural gas, I did not intend to be for long at this price. I did intend to be for long at the lower price, but I didn't intend to be for long at 217. So I am going to now sell. I'll take $100 loss. I don't care about that. So I am now going to sell, and now I'm back to 2 at an average of, I guess no, that's not, see, it's incorrect. This is incorrect. Once you sell, it's sink or swim up. I mean, obviously, if I'm flat at 217, and I am at an average of 217, because I don't care what they say. That's stupid. It's wrong, because my average is obviously 217. So now I'm at 217. So now, if we go back to 215, I'm going to happily double down again and bring my number down to 216. That's my goal. My goal is I want to see it go down. If it takes off again, I'm going to make very little money. I won't be happy. And Nikkei, he's laying around here. But again, I said I'm going to wait for Nikkei. Nikkei is another one. If we come down here, I want to add more back on this line. But I'm more worried it's going to take off on me and I miss out. So, see, here we go. We're going up. So, you really got to just learn to look at the lines and say to yourself, is this a real move? Is this a fake move? Did it, is this like you see this spike up? When you see a big spike up like that and you quickly retrace and you gyrate down, but then the next candle forms lower, you say, okay, this is out of gas, I got to get out. But you're only going to learn that by practice. It's like to some extent, I'm sorry, who said this, by the way? I forget. Stops Rich. Oh, yeah. Okay. So, look, to some extent, Rich, you're kind of saying to me, how do you hit a curveball? And I can sit there I can talk till I'm blue in the face and tell you how to hit a curveball. But the reality is, you gotta have a guy throw curveballs at you and swing at them until you figure it out. I can give you tips and tell you this and that, but you've got to do it. So you've got to open up a paper trading account and trade it aggressively and spend hundreds of hours trading so that you get used to when to stop out and when something's a fake move and what real moves look like. If you don't do that, you're not going to be a successful day trader of the futures. Now, you don't have to day trade the futures. You can go long-term like I am with the Nikkei right now. I'm a long-term trader of the Nikkei. But you don't have to. I'm a short-term trader of natural gas, long-term trader in the Nikkei. You don't have to go that way. It's all about practicing and learning and getting used to what the patterns look like. And there's no magic formula for that, okay? But when I say tight stops, I'm basically saying you want to try to lose less than $100. Or it always has to be in proportion. So in other words, if I'm looking to make, like on the Nikkei, I'm looking to make $50,000. If I lose $2,000, I really don't. That's part of it's my plan to buy more shares when they're cheap. So I'm not losing $2,000 and getting a better position that I can go long on, which I know sounds weird, but that's just the way it is. Because I want to accumulate a large amount of contracts. I want to have 10, 20 of these contracts so that when it makes a 2,000-point move, I have 20 contracts for $40,000. That's my goal on the Nikkei. I'm sorry, not even 2,000. I'm looking for a $5,000 move. If it moves 1,000 points up from 16 to 17, that's $5,000 per contract. If I have 20 contracts, it's $100,000. So right now I'm down 2,000. I'm really not worried about that. That's just part of the trade. In fact, and I only have 6 contracts. I want to have at least 10. So I'm waiting for my time to go to 10 or 12 right now. That's just part of me entering the position. So those are not tight stops. That's scaling into the position. But again, it's in proportion. I'm scaling into a $100,000 position. So losing $2,000 is like if you lose $2 scaling into a $100 position. It's not really something you should be considering that's a problem in your trade. As to the tight stop, though, you got to just make a line, and you've got to make a line, and you've got to stick to it. But then the point about the line, though, is saying if you set a stop and you say I'm going to stop at 15, it goes to 14.95, and you stop. You may as well just keep the money up right there. It's going to do that. You have to see a trend where it gets below 15, then it tries to go up, it fails, then it goes to 14.95, goes back to 15, fails, and goes a little bit lower. Then you say, okay, I got to get out of this thing. That's done. It's not making it. And then you say, I got to wait till it crosses back over 15 and play it again. Better to get in at 15.05 and lose the 5-cent move a few times than to get in and then drop below the line. You're better off having that tight stop right near the line and watching it carefully. And you take a bunch of small losses because you're looking for a big move. You're looking for a $500 move up. So if you lose 50 and lose 100 and lose 50 again while you're waiting for the good move, what's wrong with that? And if the good move never comes, you lost $200, but you know what? Next time maybe you'll catch a $500 move. But on the other hand, though, you also have to remember to take your profits when you make $50 and $100 too. I'm always starting with zero every day. I start with zero. I don't care if I made $1 million yesterday. I start with zero today. And if I lose $100, I only want to try to make my $100 back. I hate to be behind. So if I lose $100, I want to make my $100 back. If I'm up $500, then I can get them. Then I'm happy to make a more aggressive play that risks the $500. But I hate to be behind. Anytime I'm net behind, I do everything I can to eke out and try to get back to even. So on the whole, I try to have either good days or even days, but almost never lost days. So that's a whole, but I'm basically, it's like bunting, It's like all of a sudden you switch. You say, I'm not going to try to get a home run. I'm not even going to try to get a double. I just want to get on base. Because every time I get on base, if I'm down $500 and I can make $100 real quick, I'll take the $100. Now I'm down $400. Now if I get a chance to make $50, I make $50. Now I'm only down $350. You whittle, you want to whittle away at the losses. You want to get yourself together and say, okay, I don't have to make it all back in one shot. I can make it back an easy trade at a time. You're playing for like a quick bounce on something. But then the real danger is over-trading, trading at the wrong time, jumping in, forcing yourself. There's so many aspects to this. We talk about it every day in member chat. I don't know, Rich, if you're an inside member, but we talk about it all the time in member chat. It's a discipline, and you have to learn it, and you have to practice it constantly. And you do get better, but it takes years, not days. It's years of practice to get good at futures trading, to get good at day trading futures anyway. It is not a kid's game, it's a profession. Scott says, Phil, can you comment on TLT now that Yellen has spoken? I'm sure it's coming down, right? I don't have to look. I'll look. No, how am I going to look? Shit. Where is it? TLT. Yeah, we were going to do an adjustment. We didn't do an adjustment. Now it's coming down at it. No, actually, it's still going up. Wait, really? Wow. Excellent. So this is definitely. I definitely think we're done. The push from the Fed. This is the end of it, and I would say this is their last hurrah. So this is going to be a great time to make an adjustment, which means right after this webinar, I'm going to want to make an adjustment to that on our position. And what do we have for TLT? We have, there it is. We have the March 122 puts, which we didn't, look, when we took them, we thought they weren't going to do great. They did much worse than we thought, though. Went way against it. And those are down to 17 cents. So those are dead. But they're only 5, so that's fine. Now we're going to add a much bigger position. We'll probably do 10, and we're probably going to go to a longer period, like the summer. So TLT. And what are we going to look at here? June, January, no. June. All right, June's good. All right, so what do we want to do in June for TLT? They're at 133. Now, what if we did a bear spread? If we buy the 135 for 7, and we sell the 128 for 350. Well, that's a weird thing, right? It says 350, but it wouldn't be 350. It'd be 330. That's what? That's 370. Well, that's not bad. What do we say from 135 to 128? That's $7, and we can get it for 330. Did I do the math wrong, or is that right? No, that's right. Not 330, 370, let's say. All right, cool. I like that. So we can do a bear put spread here, and even then, once we have that, we can do 10 of those, and we can sell 5 of some front month puts. 132. I don't know if I would do it now, but when we do get a little bit of a pullback, we can lock in some of our profits by selling some front month puts. Like let's say we sell 5 of the 130s for $1, then we pick up $500. And if it goes lower, we can roll those, so that won't be a problem. So something like that. I think I kind of like that. I like the June 135, 128, because that's a $7 spread. We're going to buy it for like $350 or so, and we can make so we can make $350 on it. And we're only down 75. We're down 75 cents per contract at the moment, so that's what we have to make up. But we'd easily make up what we've lost so far. So I'm kind of liking that trade. That's pretty much the way I want to go. All right. So where are we? Okay, TLT. I like you, Phil Wilson. Well, thank you, Riz1. Wow, Rizwanala. Okay. I'll call you Riz because that's tough. Chow said, would I recommend a Diz? Would you recommend? I'd say that as a Disney put. Absolutely. I love Disney. I think this is really stupid. I think the valuation here is off by a mile. So yeah, if you sell the $60 put, you're going to sell that for what, $5 or something? We say 280, up $4, 375. Yeah, absolutely. I would sell an $80 put, frankly, because I would want more money. You sell the $80 put, it's $9. So so here you're getting him for 71. You're obviously getting him for much less. But meanwhile, I'm very comfortable with 71. That's the thing. So why would I not take like more than double the money when I'm just as comfortable with that target as the other? You have a Disney 8100. Would you buy back the short calls and take the profit now? 218, 8100. Well, how much are they? No, I would not pay 875 for the 100. You have the 80s. See, here's the thing. You can pay 875 for the 100s, or you can invest 875 in these and go to, and move and roll them down to the 165s. Well, let's see how much that is. You have the 80s for $18, and if you add $8 to that, how much did we say that was? $850. So if you add $850 to 18, that's $2650, right? So $2650 takes you almost to the 65. It certainly takes you past the 70s. So if I were going to do it, I would go that way and have a much better spread. But on the other hand, I wouldn't do it because what's my rule about that? I only buy if I'm getting double my money. So I would only pay $5 to roll down $10. Now, if you look at the 75, these are 1820 and these are 20. They're not really 20, they're 21. So from 1820, see, I would do that roll because that's like $250 and you can get a $5 roll. From these guys, it's not though. Here's like $3 or $4, so I wouldn't do that roll. But I would spend a little bit of money to go to the 75, and that widens your spread. So why not do that and leave the 100s? Because you're supposed to sell premium. That's your job. Your job. You are the house. Be the house. Sell premium. Look, Steve Wynn doesn't go to the roulette table and say, I think it's going to be 33, so please don't sell 33. Or he goes, don't sell any blacks. I think black is going to come up now. That would be stupid, right? His job is to take a bet on every single number on the roulette wheel because he knows that if everybody bets every number, and in the aggregate they do across his casino, that's why they have 100 roulette wheels, because they want to make sure as many people as possible bet as many numbers as possible at any given time, because then it doesn't matter who wins, the house has a net advantage. So it's the same thing for you. It's not your job to gamble. It's your job to sell premium. You sold premium. Why would you buy it back? Now, if it was 50 cents or $1 or something silly like that, and you know for a fact you're going to have a better sale down the road, great. But Disney is struggling at $90. It's not going to come ripping back. And so, like I said, I think the fair value is around 100. So you bet the fair value. You sold the premium for a fair value. So stop having this fantasy about it like skyrocketing back to 120 and you're going to regret it. And now you're going to spend $9 now or $8.50 now because sometime down the road you might somehow wish that you had done it. So now you're going to definitely spend the money because maybe one day you'll regret not spending it. That's kooky logic. Hey, you sold that premium. You will absolutely never pay this guy back his money. You have that money in your pocket. Why take it back out? If you want to do something instructive, take the valuable stock calls you have and improve them. And you can improve them $5 by spending $250. So you're guaranteed that you're getting $250 in the intrinsic value. That's in the money value. So you're getting $250 guaranteed extra money for spending $250. That's the kind of thing you spend money on, things that are guaranteed. Don't gamble. Your job is not to gamble. Your job is to do things that give you better positions. Your job is to do things that give you absolute returns. Gambling is what you sell. Wait, what's going on here? Wow, I'm so confused. All right. Can you explain something? We talked about that ages ago. Okay, Robbie says, regarding the 4 trade, do you recommend buying that combo as one trade or 3 separate trades? No, I always put everything in separately. I do every leg separately. There's almost no time I will ever put in the spread. Not only because it's a hassle to put the spread in the first place, but they never fill. You sit there and stare at them forever. The legs fill, boom, 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 they'll fill out. But when you put in a spread, it can sit there forever. You know why? Because the market maker who's in charge of filling your spread isn't going to fill the spread unless he has a benefit, unless it's a benefit to him on both sides. So unless he can make a nickel on both sides, he's just not going to fill your spread. And it's going to sit there, even though you could have filled it 10 times by doing the individual legs. It's never going to get filled. So the way we go into spreads is we offer a beneficial price on all the legs, and whichever leg fills first, then we make adjustments to the other legs to try to realistically fill them. Sometimes they will fill those. Sometimes I'll offer like 5% better on each leg, and I'll fill all 3 legs at better prices. Because first of all, you're talking about 2018 trade. You have 2 years to fill it, and you're going to worry about today filling it? That's ridiculous. Ford will go up, it'll go down, it'll go sideways, it'll go left, it'll go right. And it also matters which end you fill, because if you're bullish on Ford and you fill the short puts first, you don't care. That's the non-issue, because you were bullish on Ford. If you fill the long calls first, you don't care because you're bullish on Ford, so you're willing to ride something out. If you fill the short calls first, though, then you're going to be worried because you fill the short calls and you don't want to be short. You don't want to be short on Ford, so you're going to quickly want to at least fill one of your other legs. You have to think about that too. You have to think about which one filled and what position does that put me in now. Steve Holt says bonds, question mark. Yes, Steve, bonds, question mark. Bonds, James Bonds. I have no idea what that's about. Do I like bonds? I don't like bonds. I would never buy a bond. Well, I would buy a bond if they were offering like 15% interest, if it was like a government bond, because I would assume the government survives. But other than that, no. Even Greece survives so far. What's your take on BA? Yeah, we just did a BA trade. I forget where it was for, and I know I didn't update the portfolio since we did it. But BA, of course, absolutely love them. BA has $50 billion worth of planes on back order. $50 billion worth of planes. And Airbus has probably a similar amount of planes on back order. Now, if somebody who's halfway in the line, right? And Boeing, by the way, so just to put that in perspective, this is important because obviously it doesn't mean you can say they have 50 billion planes on that. I'm sorry, did I say 50? $500 billion worth of planes are on back order. Sorry, not 50. If you look at their income statement, they sell $100 billion worth of planes a year. So it will take Boeing 5 years at least, because more plane orders come in constantly. It will take them 5 years just to work through their back order. And the only reason if somebody cancels an order or gets out of the order, they lose their place in line. So if somebody's due for delivery in 3 years, and they say, oh, I changed my mind, then the next time they're going to get a plane is 5 years from now from Boeing or Airbus, unless they're like a super powerhouse airline that has incredible buying power, like Continental could get away with it or something like that. But any normal airline canceling an order for planes is going to go right to the back of the line, and they're going to wait 5 years for delivery. So nobody is canceling orders. The only reason orders got canceled in 2008 was the entire economy collapsed, and people couldn't get money for the leasing and so on and so forth, and the whole thing fell apart. But you know what? It recovered pretty damn fast, too, for Boeing, because people need planes. They constantly need planes. People are not going to stop flying. We've seen that. People didn't stop when planes are being blown up. I mean, yeah, I don't know if you guys remember it. In the 70s, planes blew up all the time. Wow, is that the old Yahoo format? What's going on here? Did they go back to the old format? Oh, that's great. I was so angry about the new format. What? That's weird. Let me see this. Oh, it's take away the beta, because mine is beta of Yahoo Finance, so I hate it. It's interesting. Okay. I'm in https://beta.finance.yahoo.com, and I hate it. I didn't even know you could still use the old one. Anyway, so this is nice. So what were we saying about Boeing? I was going to show you something. I forgot what it was. Wow, totally have no idea where we were. Anyway, they have $500 billion worth of planes on back order. It's going to take them at least 5 years to fill it. Okay? And they're going to sell it at the price they want to sell it for. They're going to make the margin they want to make, which isn't much, frankly. There's only 5% margins. But they're going to make their bottom line. There's no reason to sell planes for less money than they need to because everybody wants them and needs them. Oh, I told about the rollover for the airlines. That's right. So these airlines, they constantly need new planes. It's just like you need new cars if you're hurt. You have to buy the cars if you want to stay in business. You can't not buy them. They do wear out over time. You do need new ones. You have to keep up to date. You know, people, like you go on some of these airlines, like the discount airlines, you go on and they got these old planes from like 20 years ago. It's hard. Oh, I know what we're talking about, terrorism, right? Oh, that's what I wanted, the Boeing chart. See, I got back on track. So the Boeing chart, if we go 10 years, here was the crash, went from 100 all the way down to 40. Terrible, terrible tragedy, right? But look how fast we got back to 75. If you just keep your head when something bad happens and double down on Boeing, you'll get your money back really quickly, and then you're like incredible shape going back up. I was banging the table on Boeing here. I always do. Whenever there's a tragedy, it hits Boeing. This was the battery tragedy. I think this was, anyway. Was it here? Is that long ago, or was it this one? I don't know. Well, one of these was the battery tragedy when they had the battery fire. I think it might have been there. And that was nonsense, and we bought there. And now it's down here for no particularly good reason, and it might go lower, but this is a good place to start, like accumulating some Boeing. But you have to plan that if it goes down to 75, you're going to buy more. Otherwise, otherwise this is going to be a scary place to get in. But I like Boeing here, for sure. They have $500 billion worth of planes on back order. And my point was here, though, that here they had a lot of cancellations of orders because people couldn't get financing. The airlines were almost bankrupt. They had to cancel their plane orders, and they had to change it. And everybody acted like no one was ever going to buy planes again. And I was saying, this is absolutely the most ridiculous thing I've ever seen. It's freaking Boeing. It's not like there's somewhere else to go for planes. There's only two people that sell planes. I mean, there's others, there's Embraer or whatever. But there's only really two major sellers of planes, and they're completely swamped with orders all the time. So you just wait for this little aberration to wash out, and all of a sudden they're going to be back, and look how it came ripping back. So if they go down again, every time they go down, it's just an opportunity to buy. I mean, obviously you want to watch their actual value. When they go up too high, then you sell, which we did, of course. But here you're talking about a forward PE of 12. That's what they're down to. As if they're Apple or something. only Apple gets punished worse than Boeing. So they have a forward PE of 12, making planes, having a duopoly in a massive industry. It's the stupidest thing in the world. So that's just a great opportunity whenever Boeing gets cheap. Well, look, I'm catching up on answers. Is that right? Yeah, that's good. Great. Regarding the Ford trade, now what happened? Oh, we talked about that. Yeah, okay, great. I am catching up. Why do you feel we are not at the beginning of a true bear market capable of going there? Well, because of the valuations. As I said, go look at those links that I have. We did evaluation of all the Dow components. We did evaluation of all the S&P components. There is not a case for them being lower. You can't make the case for a 40% devaluation. Why would it go 40% down? Why are really things 40% mispriced? There are some things that are. Amazon is 40% too high. Tesla is 40% too high. Netflix is 40% too high. But you know what? That doesn't affect the whole S&P. That's the reason that we went to 2100, because we had these stupidly high prices on things, and instead of being at 1850 where we should have been, we come back to 21. We went to 2100. Which is about 20% too high. We went to 2100. But so the drop from 2100 back to where we should be, in other words, okay, you know what it's like? It's like in the spring, it's 60 degrees. Then in the summer, it's 90 degrees. Then it goes back to 60 in the winter, in the spring. In the fall, it goes back to 60 in the fall, then it goes to 30 in the winter, and you're saying, well, why do you think it'll go to 0? Because 0 is not the right number. That's why. Just because something goes down 20% doesn't mean it can go down 40%. Okay, the 20% was too high. When it was up 20%, it was too high. Now it's at the right price. It could go down 10, 20% from here, but it ain't going to go down 40%. That would be idiotic. I mean, yeah, some stocks can, but all the stocks are mispriced by 50%? Well, I mean, down 50% from here would be 100%. You're saying they're 100% overvalued? That they should have a PE of 5? That Apple should be trading at the amount of money it makes Apple should be trading at 5 times what it makes in a year? That Boeing that we just looked at should trade at 6 times what it makes in a year? That's ridiculous. And frankly, when we had the crash in 2008, when the market was down half of where it is now, it was clearly wrong because it only took a year to come back. It gained 50% of its value in 1 year after that because it was clearly way under the price. And yeah, markets are capable of going down that much. If China explodes, if Japan blows up, if Brazil goes bankrupt, things can happen that can send the global economy lower. We could have a huge liquidity drain, and all of a sudden everybody's going to be going down and we'll panic again. But you know what? That still doesn't mean that things aren't worth what they're worth. It just means you're going to have to ride it out and wait for things to come back. And anyone who did that in 2008 did fine 5 years later. It's the people who panic that get burned, the people who liquidate their holdings and take a huge loss because they think it's going to go up even lower than that. And till I was blue in the face, I would tell people back in 2008 and 2009, I said, you've got to buy now. You cannot sell. You can't liquidate and get to the sidelines because you will get burned so fast. You have to say, the problem is a lot of you guys, you never owned a business. That's a big problem for a lot of people who trade, that you never actually owned a business. You do own houses, though. And you have to realize that, like in 2008, in the crash, your house price probably dropped 50%. But you didn't sell your house. Hopefully you didn't sell your house. If you don't sell your house, it comes back in value. How does it affect you that the house lost 50%? It's just a number. It doesn't mean anything. You bought the house for the long term. It serves a function. Stocks are like that too. If you buy stocks with a 20-year time horizon, if you buy stocks for the long run, if you have a long-term expectation for a stock, then you can look at it with a more objective thing. If everything you buy, you have this mindset that it has to make 10% this year or it sucks, you're going to be very disappointed with a lot of things and you're going to take a downturn very badly. But if you were going to be a value trader, like I like to trade, like Buffett likes to trade, then when you see a downturn, you've got a perfectly good stock like Boeing and it goes to half price, you say, damn, time to buy more. Because all I do is I look at the business. Now, obviously, some things could be affected. Like oil, I certainly wouldn't be jumping into oil companies right now. They're not going to come back. They're not going to go back to where they were because the business has changed. But Boeing's business didn't change. Apple's business didn't change. Disney's business isn't changing. It's changing in the overall makeup. They're going to de-emphasize ESPN, and they're going to do more parks. So, and what's Disney doing? This is what kills me also about Disney. What's Disney doing? They are spending less money on sports. They're de-emphasizing the sports part of their business, and they're spending more money on theme parks, which are going like gangbusters, and hotels that they sell. And they're building a gigantic $5 billion thing in Shanghai, and they're spending another $5 billion adding Star Wars to California and Florida parks. That's $10 billion they're spending on non-ESPN stuff to generate a whole new stream of revenue to replace ESPN. They're doing exactly what they should do to adapt to a changing market. Just like IBM doesn't make typewriters anymore, they now do this and that and that. Okay? That typewriter division's dead. Used to be the whole company. Now it's dead. You invest in companies that adapt and survive and are able to change themselves with the times and move forward. And if they're off the wrong path and if they're going the wrong way, you need to identify that and get out. But the price of the company, while it's doing all that, doesn't mean a thing. That's other people's opinions of a stock, and that shouldn't matter to you. Just like somebody else's opinion of your home's value doesn't matter to you. Okay? That's the way you got to look at things. You have to have your own valuation. You have to have a use to something where it fits in your portfolio and does a job for you and it generates an income for you because you're selling options and calls and puts against it, I hope, so that you're generating an income or you're collecting a dividend at the very least, and the stock is working for you. But if you're buying nothing but speculative stocks and expecting these giant gains, you're going to have really crappy times, especially in volatile markets like this. That's why, that's why our long-term portfolio, where we barely touch it and we just buy things for the long haul, where is it? Here's our long-term portfolio. It's up 30% in 2 years, 15% a year. Okay, and it can easily pop back up 10% with the market, but that's, it doesn't really matter. But in the long-term portfolio, what do? 27 short puts. Every month, we sell a short put. Every year, half of them expire. Look how many, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Oh, here's one that's expiring March. I guess I should count. 12, 13, 14, 15, 15 of 27, which is just right, are going to expire this year or by January. And over the course of this year, so at the most we're going to have, at some point in the year, we might have like 30, 40, we might have like 40 of these things. But generally, every month we sell puts. Then in January, half of the puts go away, they expire, and then we have the 2018-2019 cycle. But every month we sell a put so that we don't have too many at once. And we try to gain about $5,000 a month on a short sale. So then the only reason we would end up owning a stock, so here you go, here's Alcoa, right? Alcoa, we sold the $13 puts in 2015. Now it's at $7.59. We sold them, though, for $2.45, so we basically have a net 10 on the trade. And currently it's at $7.59, quite a bit below 10. All right? We're down 133%, but that doesn't matter. What matters is whether or not we think it's going to be higher than 10 so that we don't lose any money but in January. Now, right now, aluminum is having a tough time. But the thing about Alcoa is we kind of wouldn't mind owning them long term. So we could always double down. We could always do a lot of things. We'll come back to 10 by the end of this year. If we think that can happen, there's no reason to change that trade. If we get worried, we would roll it to a 2018 something. Here's AA. And let's see, we sold the 13s, and the 13s are $6-ish. And we could roll it down from 13s to the 12s. That's not very exciting. Or we could do a double roll to here. But also don't forget though, the 13s, if you look at it, it's $7.50 now. So that should be $2.50 plus 3 is $5.50. So no more than $5.50 should we be paying for these. And they're right about $5.50 now, so there's really no premium left in these. So if we want to sell premium, we would roll it to 2 times the 10s, and then be short the 10s, because we really do think 10 is a good target. Maybe we're not going to hit it this year. But we're not in a hurry. There's no emergency to do it. And the bottom line is we like Alcoa. I think we did double down when it was at 6. I'm not sure exactly how that trade went along. How many do we have of these? A lot? No, 20. Yeah, I'm pretty sure we doubled down when it was at 6, and now so we're stuck here at this price. But it's not bad. That's why we have such a $2.45 sale price. But the bottom line is if we double down, then we're going to have 40 Alcoas at $10. I don't mind having 4,000 shares, $40,000 worth of Alcoa at $10, because then we start selling calls against it and making money. So there's not a bad outcome here. There's not an outcome I'm really worried about, and that's where the play is. So some of these things, a lot of these things in this market are down quite a bit. And in fact, frankly, in the long-term portfolio, we have $885,000 in cash. Our current positions are down $250,000. That's why we're only up 30%. We've got incredible amounts of cash, but our positions are in crappy shape, mostly because of all these short puts. Look at USO. We sold the January 15 puts of USO, and we're at half of the number that we could be. But you know what? We think in July it's going to be quite a bit higher, so we have no reason to change this, even though they're down 250% and down $12,000. We have no reason to change it, because just a few weeks ago this thing was only down a few $1,000s when oil was back at like 35 something. And it's another year for the trade. So we don't care what the price of something is. We care what the value is to us. We like all these things. We go over them on a regular basis. Once a month at least, we go over all these trades. We like all these trades. We like all these positions. Now, not only that, though, but of course the long-term portfolio is what, $650,000 for the long-term portfolio. 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 $650,000 usually it goes the other way, but by accident, the way we ended up trading, the short-term portfolio, which was started on the exact same day, that's up 300%. So instead of making all our profits like we usually do in the long-term portfolio, we made a ton of profit in the short-term portfolio. That's got a ridiculous $400,000, and it's also all cash, basically. And so, because what happens every time, we play our shorts there, whenever we want to protect the long-term portfolio against a loss, we put it in the short-term portfolio to trade it. So this portfolio that started with $100,000 is up to $400,000 already. Between the two, though, we're at $1 million. We're well over $1 million, starting with $600,000 between the two of them. It's just in an unusual set of events over the last 2 years, the short-term portfolio has done much better than the long-term portfolio, and we haven't transferred the cash. But either way, if you look at it, the bottom line is we have $1 million. We started with $600,000. That's up 66% for the pair in 2 years. So, that's exactly where we want to be. And so because of that also, we have no reason to fear any of the losses in the long-term portfolio because all the gains are over here. Usually that's not the case. And usually also we would have transferred the money, but as I said, in a very unusual circumstance, the long-term portfolio isn't losing money. Usually when the short-term portfolio is up, the long-term portfolio is down, and then at an extreme, if the short-term portfolio makes $300,000, you'd expect the long-term portfolio would have lost $300,000 or something like it. That didn't happen. So we're sitting on all this cash in the short-term portfolio and really haven't got much to do with it because we aren't seeing a lot of short-term trading we like. But we do see plenty of long-term stuff we like, so we just keep buying things and we keep adding to our long-term portfolio. And if the market ever comes back, that long-term portfolio money is going to shoot through the roof. So that's how we're playing it right now. It's just crazy. In the butterfly portfolio, that's the one that's self-hedging. And that's up 80%, also in about 2 years. This one's a much steadier grow rate. It's a much good, slow, steady, very nice positions on the butterfly. And what do we have? Long-term, short-term butterfly and 5%, right? Those are active. And the 5% portfolio is disappointing. But again, it's down 9%. But the funny thing about the 5% portfolio, first of all, these Qs, this is all of our losses. This is more than all of our losses. This is SQQ play, right? Number one. Number two, we've got $128,000 in cash. Our current positions are down $37,000. All we have to do is keep adjusting our current positions so that by the end of the year they don't lose $37,000, and then we'll have $128,000 cash without any losses. So that's how we're going to make $40,000 from where we are now. All we have to do is adjust these trades so that by the end of the year we don't lose money. And to that extent that we can do that and pull that off, we will then have $40,000 more dollars. And all we need is not even a big up move in the market to get there. So, and then again, we have to go over all these trades now. But on the whole, we were down as much as almost 40% when the market was crashing. So we're already in much better shape. But so we came back 30% in a few weeks. We'll come back another 30%. And we'll be back on track because we really want to make 60% for the year, not just 40%. But anyway, so that's how we adjust these things and move through it. But you have to have that overall strategy and the overall plan, and you have to know the value of things. And by the way, that goes true. Because we were very aggressive, we are very aggressive in the 5% portfolio, in the options opportunity portfolio. We're being very aggressive, but it's because we feel confident that this is a floor. So when it gets lower, we buy more stuff. We add to our positions. We don't panic and cash out. It's a completely different concept. We are saying we think this is a floor. We're playing this to be a floor, and if we're right and it comes back, the thing's going to go up 60% for the year. Oil demand. What that going away? Who are the most vulnerable targets? Service companies, rigs, the majors. They're all vulnerable. The whole oil sector. Look, long term, I don't think much of the oil sector at all. It's going to be a lot of consolidation. There'll be some M&A. There's going to be less companies left. But you know what? It's like the miners, though. They figure out a way to win because, like ABX, right? They had 140 million ounces of gold 2 years ago. Now they have 100 million ounces of gold. They sold 40 million ounces of gold at $200 an ounce. which is, I think, I'm going to take a chance and say $8 billion. Is that right? 40, I'm going to calculate it. If you sell 400 million ounces of gold times 200, 80 billion. No. Do they sell $80 billion? That doesn't make any sense. 400 billion times 200 bucks is 80 billion. That's weird. Anyway, I can't believe it's 80 billion. It could be. I got to look at the numbers. But they sold 400 million ounces of gold. That's the bottom line. They paid off debt, sold a whole bunch of gold. Now they still have 100 million ounces of gold left in the ground. But all the gold they have left is the cheapest gold. That's smart, right? The gold they have left in the ground cost them like $850 to pull out of the ground. Everything that cost more than that, they sold. So now they're left with very low-cost mines. And even though the price of gold is low, even though it's coming back a bit, but even though the price of gold is low, they now make plenty of money on it because they have less mines that they operate, they have less debt, they have less this and that, and they're selling gold for a much wider margin at the same price, even in lower quantities. And the oil companies have to go through that same very, very painful process. So they're going to have to get rid of their unproductive wells. They're going to have to get rid of their the high cost wells. They're going to have to tear down their things and eventually roll their production down. But then they'll survive. All right, and so it's tough for people who have a big cost infrastructure costs like rigs, who have a lot of big machines they have to pay off, and if nobody wants them to rent, that's a problem. But if there's not a lot of drilling for new wells and such, that's going to be a problem for Rig and for Baker Hughes. But they'll still adjust in the lower cost environment. Okay, the problem was with Rig and Baker Hughes is that we were overproducing. Everybody was speculating and drilling wells like crazy, so the companies were going full guns. And then everybody stopped speculating, and now there's barely any need for rigs because they've already got all these holes they haven't even used yet. They drilled all these wells with the rigs that they haven't produced any oil from because it's not worth pulling it out of the ground. Even though they found oil with the rig, they say, oh, we found oil, but it's $60 oil or it's $45 oil to pull out of the ground. That means nobody's going to pull it out of the ground right now because they're not going to get their money back on it. So they leave it capped and they walk away. And that means they don't need to drill for more holes. They already have one. So that's what's killing them now. Long-term recoveries on these guys. It's not, you don't expect them to bounce back. Don't even expect them to ever recover to where they were. But long-term, they're probably pretty solid companies. UNG trade. Yes, Bernie, we have a UNG trade. Declan, what do I drive now? I now drive a Toyota Venza. I gave up my Range Rover because, frankly, because I went to get another one, and I was like, you know what, this is stupid. Because I usually buy a used one. I don't buy new ones. New ones are a waste. Where is this question? Anyway, I don't buy new ones because the new ones are a waste. Sorry if I use Range Rover. I didn't like the pricing this year when I went to get a new Range Rover. It was like in November, and I wasn't happy with what people were charging. Also, I don't ski as much as I used to. So, it's like hard to justify. I love it, but it was hard to justify. And my brother sells Toyotas. He asked me to check out the Venza, and I liked it. I was like, oh, it's a nice little car. It gets incredible mileage. It's like 25, 26, 28 miles a gallon. And so compared to the Range Rover, the time gas is still not that cheap. It was like $250, I think, at the time. So, and it's not like it's a big deal of the gas, but I just, it always annoyed me in the Range Rover to spend that much money every week on gas. I felt like it was a real waste, especially now my kids are 13. Both my kids are teenagers. I honestly could just I'd rather give them the money than throw it into my tank all the time. It makes them super happy to get $50 a week or $100 a week. So why should I put it into my car? So that was my logic, and I went and got the car. So it's nice, and I don't drive very much anyway, so it really doesn't matter to me. I was never a car guy, but I did like having my nice big Range Rovers. And I can't honestly say that I won't go back to a Range Rover after this car, but I got this one for 2 more years, so we'll see. Or, well, 1 more year, depends. I mean, I have an excuse to give it to my daughter. And another reason is that this was going to be a car I was going to give to my daughter, Madeline, because she just got her permit. So that, again, went into my thinking. It's like I didn't want to get her a Range Rover and have her be like the jerk at school with the Range Rover. So that was another reasoning on it, is I wanted to get a car that was sensible for a teenage girl to have. What do we do with ABX? Should we take profits now? I I don't know. I mean, if you want to take profits now, I don't think I'm taking profits now. I don't know what the trade is. It depends on what you... If I had a call, I would take profits because it shot up like crazy. I mean, we took profits on gold. That's interesting, matchup. We took profits on gold when it hit 1,200. So for the same logic, you take your ABX profits, but I certainly think it's going to be good for at least, probably 15 or so over the course of the year. It was just stupidly low. It never should have been that low. I mean, there was just a ridiculous price when you look at the numbers on ABX. There's no way you come up with that number. All right, got to wrap this up because, oh my God, I got to go. I have to now go talk in the city on TV for this whole thing. I got to do this whole show over again, basically. Do you like CL below 2750? Oh, is it below 2750 now? Oh, God. No, it's 2769. Yeah, I do like it at 2750, but really tight stuff. It's got no support below this level. Also, can we clean up some of our trades like in Taser, please? Well, yeah, I'd like to do that. It's not going to happen today. We're going to hopefully tomorrow and Friday we can work on the portfolio trades. I think Spies and the Bear Flag are going down. I totally disagree. NK is different from NG. How? Because NGK6 is May and NG is a front month contract. Oh, you figured it out. What about LNG? No good. They keep delaying their things and their terminals. I mean, our natural gas trade depends on them executing in March and April and starting to export, but I didn't like the fact that they put off their exports. It was very bad. They really screwed up our time frame. We had to dump out of our long NG positions, and now we just started getting back in because they screwed up our time frame. So we originally had April's, and now we've moved to June's. Fortunately, we caught it at the right time, so we actually did well on it. Declan says, you can get another one when you come over to live in Ireland. We can trade futures in the morning, hit the pub by 3. Yeah, that's my plan. Mike says, in futures, when do you switch from the March to June? Oh, by the way, as far as that car goes, it's true, because this is the other reason. I've had that car since November a year ago, so 13, 14 months? I've got 8,000 miles on it. So I'm not a big user of a car. It's not my thing. Declan says, you can get another one when you come over and live in that place, right? So for me, it's like, I would like to get a scooter. I've been keep bugging my wife. I keep telling Tina I'm going to get a scooter. She's like, you'll kill yourself. I'm like, I really would like just like a little thing to scoot around town in. In the summer especially, I like that. Mike says, futures, when do you switch from March to June contracts? When do you switch? I mean, will you switch when you think your target? If you're in a long-term futures, you have to think about when you're going to hit your target date. In our case, with natural gas, because of LNG delaying their exports, we adjusted our time frame and went for the longer contract. But I'm not sure what you mean by March to June, because we're in the May contract. There are no June contracts. If there were June contracts, we'd be in those. But we took the longest ones we could at the time. May says, can you please put a new option spreadsheet up with new positions? Yeah, the positions there are pretty accurate, but we are going to go over it, and this week we're going to have a new one. Well, not a new one. I'm going to have an updated one anyway. How would you trade Cisco for earnings? I love Cisco because the Internet of Things thing. I love Cisco long term. I've been saying that since forever. That was another one I used to pound the table on when they crashed in the O days. I don't know what they're going to do now. I do like them long. I would hope that they have bad earnings and that we can pick them up around 20. That would be fantastic. As a long range, I must be doing it. I don't see it. Always comes back to the same page. But if we look at Cisco over time, all right, so on the whole, they're not at a super attractive place. They're kind of in the middle of the range that they've been on since pretty much forever. Let's see how far this does go. Yeah, look at this. Here's 25 and 04. So before the idiocy, before things went crazy, they were a $20 stock. Then things went crazy, but I wouldn't even see, I would throw that out. That's like a spike that I would ignore. So it's like, there's nothing there. So this is their price range right here. So basically $20 is where they trade. That's their number. So there's nothing exciting about $22.59. I would rather see them miss or disappoint and pick them up cheaper. But if they take off and they look good, I'm going to be happy to sell puts on them also. I do want to be in Cisco. I like them long term. All right, that is a great way to end this meeting. We'll take one last look at the thing. Oh, wait, somebody said something. You said you would exit ABX if you had a call, but there is a call. Is there? All right, well, then probably we should take money on it. Again, I'll go over the portfolio tomorrow and tomorrow and Friday, whatever. And, ew, everything got yucky. Well, not the NASDAQ. Interesting. The NASDAQ's up 1%. The Russell's up 1%. The Dow and the S&P are obviously having trouble.